AI infrastructure ETFs are up over 25% this year. The global index fund most UK investors hold is up about 8%. If you're sitting on VWRL looking at those numbers, there's a question forming in your head right now, and it's a good one. The answer, though, isn't what the headline suggests, because the most surprising thing about this comparison isn't the return gap, it's something underneath it that almost nobody checks. Let me show you. Picture this. You opened your ISA, you did the right thing, you bought VWRL, the Vanguard FTSE All-World ETF. Globally diversified, low cost, sensible. It's up 8% this year, and you feel fine about it. Then a headline lands. AI infrastructure ETFs up 25%. You look it up. AINF, the iShares AI Infrastructure UC ETF. LSE listed, ISA eligible. And suddenly that 8% feels a lot smaller.
This is where a lot of UK investors are sitting right now. Not reckless ones, smart ones. Because when you see a 17 percentage point gap between two ISA-eligible funds in the same 12 months, it's completely reasonable to ask, am I holding the wrong thing? So let's run the actual comparison. No hype, no sales pitch. AINF against VWRL. Same tax wrapper, very different bets. And we'll let the maths decide. Before we look at the numbers, let's be clear on what each of these actually is, because the names don't tell you nearly enough. AINF, the iShares AI Infrastructure UCITS ETF, tracks the stock's global AI infrastructure index. In plain English, it holds the companies building the backbone of artificial intelligence, semiconductors, the chips that power every AI model, data centers, the buildings full of servers running them, networking equipment, the cables and switches connecting it all.
Think NVIDIA, TSMC, Broadcom, and the companies that supply them. Around 70 to 100 companies in total. One theme, one concentrated bet. The ongoing charge is 0.35% a year. VWRL, the Vanguard FTSE All-World ETF, is almost the opposite. It holds roughly 3,700 companies from across the entire world. US, UK, Europe, Japan, emerging markets. Every sector, every size. Tech, banks, healthcare, energy, consumer goods. If a company is large enough to matter and publicly listed, VWRL probably owns a slice of it. The fee is 0.22%, lower than AINF. Now here's something most people don't realize. VWRL isn't ignoring AI, because the biggest AI companies in the world, NVIDIA, Microsoft, Amazon, Alphabet, are already among its largest holdings. Around a fifth of VWRL's entire value sits in the technology sector. You are not choosing between AI and no AI.
You are choosing between concentrated AI and diversified AI. That distinction is going to matter a great deal by the end of this video. Let's start with the return gap, the 25% versus 8% that probably brought you here. The AI infrastructure theme has had a genuine run this year, and the reason isn't speculation. Hyperscalers, the biggest tech companies in the world, are spending more than £600 billion on AI infrastructure in 2026 alone. Data centers, chips, power grids, the money is real, and the companies building the hardware have seen that reflected in their share prices. AINF caught that wave, up roughly 25% year-to-date. If you'd put £10,000 in at the start of the year, you'd have around $12,500 today. VWRL would give you $10,800.
The gap is real, but the year-to-date chart is only telling you half the story. In early June 2026, something shifted. Broadcom's earnings disappointed. A strong jobs report killed expectations of a rate cut. The Nasdaq fell 4.2% in a single session, one of its worst drops in a year. $1.8 trillion wiped from U.S. equities in 24 hours. VWRL fell, roughly 2 to 3%. Painful but manageable. AINF, which holds the exact companies driving the sell-off, fell considerably harder. Because AINF isn't just up more than the market when AI is running, it moves more in both directions. The same concentration that gave it that 25% gain amplified the losses when sentiment turned. That's not a bug in AINF, it's how thematic ETFs work, and it's the feature most people forget when they're reading the headline.
Then there's the fee gap.
The difference between AINF and VWRL is 0.13% a year. On its own, almost nothing, but over 20 years on a portfolio worth £200,000, that quiet difference compounds to roughly £3,000 in extra charges for AINF. AINF has to earn that premium back through outperformance every single year. When it does, fine. When it doesn't, you're paying more for worse. Now let's run the projection, because this is where the real decision lives. Assume you invest £500 a month into your stocks and shares ISA for 20 years. Total money in £120,000. With VWRL, assuming roughly 8% annual returns after fees, you'd end up with approximately £285,000. Your money more than doubles. That's the base case for global diversified investing in an ISA.
Now with AINF, the outcome splits into two very different scenarios, and both of them are plausible. Bull case, AI infrastructure continues to outperform. AINF delivers around 12% annually after fees. After 20 years, you end up with approximately £470,000. That's £185,000 more than VWRL. The concentrated bet paid off. Bear case, the theme slows. Competition erodes margins. Valuations correct towards the mean. AINF delivers around 6% annually after fees. After 20 years, you end up with around £215,000. That's £70,000 less than VWRL. The concentration cost you. Same monthly investment, same 20 years. Either £70,000 worse or £185,000 better. That £255,000 range is the actual size of the bet you're making when you choose AINF over VWRL.
And here's the thing about the bear case. It doesn't require a disaster. It doesn't require AI to fail. It just requires AI infrastructure returns to drift back towards the broader market average over time. Not a crash, just normalization. Now here's the part that changes how you look at all of this, and it's what I hinted at in the beginning. Remember, VWRL already owns the biggest AI companies on the planet. If NVIDIA continues its run over the next decade, VWRL goes with it. If the AI boom lifts Microsoft and Amazon to new highs, VWRL participates. You are not missing the AI story by holding VWRL. You are writing it, with 3,600 other companies providing diversification underneath you. Choosing AINF over VWRL isn't adding AI to your portfolio. It's removing everything else. You're trading global diversification for a single theme, and betting that theme outperforms the rest of the world for 20 years.
Sometimes it will, sometimes it won't, but that's the real trade-off, and it's worth being clear-eyed about what you're actually doing. So what should you actually do? 3 things. 1. If you're already in VWRL, don't switch. You already own NVIDIA, Microsoft, and the biggest AI companies on the planet. You're in the AI story. The question is only whether you want to go heavier on it. 2. If you want more AI exposure, use AINF as a satellite, not a replacement. Keep 80 to 90% of your ISA in VWRL or a similar global index fund. Put 10 to 15% in AINF. That way, if AI infrastructure keeps running, you capture more of the upside. And if it corrects, the bulk of your portfolio is cushioned. 3. Be honest about the volatility before you commit. AINF swings harder in both directions.
During the June 2026 crash, AI-heavy portfolios dropped significantly more than the broad market in a single session. If you'd struggle to sit through a 7 or 8% drop in your ISA in one day without hitting sell, VWRL is the right call. The best investment is always the one you actually hold through the bad weeks. Remember the projection we just ran. The gap between AINF's best and worst case over 20 years is £255,000. That's not a rounding error. That's a retirement outcome. Choosing AINF because it's up 25% this year is not a strategy. Choosing it because you genuinely believe AI infrastructure will outperform the broad market for 2 decades, and you can stomach the ride, that is. Both AINF and VWRL are available inside a Stocks and Shares ISA on platforms like Trading 212. Link in the description.
If you're not in an ISA wrapper yet, sort that first. There's no reason to pay tax on gains you don't have to. If this video helped you think more clearly about where your money sits, hit subscribe. We put out new videos every week, breaking down your money in plain English. No jargon, no suits, just the numbers that actually matter. Until then, this is Monkey Finance. See you in the next one.